I read a Wall Street Journal editorial piece today which cited a stat to say that home prices are 13% below last year. That surprised me, and it's blatantly wrong, of course. The fact is that home prices remain just fractionally above where they were a year ago. The point of the editorial was to scaremonger over government programs to help home buyers and student loan borrowers. And if home prices are tanking, that means more borrowers are underwater. So the author tried to use new construction prices from back in April to describe the whole US market now. It was poor journalism, of course, but probably effective scaremongering. The fact is that home buyers in May of last year in like Austin, Texas, are probably underwater a bit. But in general, home prices across the country are roughly unchanged from last year at this time. That's frankly surprising given how cold the market froze last fall. We have significantly fewer home sales happening now, of course. The supply of homes for sale is very low. And most of the year, we've had more buyers than sellers. There are no signs of any surge in listings, and as a result, we've seen a floor in home prices. This week continues that trend. New contracts dipped as affordability is out of reach for so many people. Inventory is very low and just inching up now week over week late in the summer. There are no signs in the data of home prices tanking, and we stay vigilant to watching for either any surge in inventory or home prices to tank from here. Neither of these trends are materializing yet. And the evidence shows that the trends can change quickly. That's why at Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data, so you can understand immediately the changes that home buyers and sellers are having on the housing market. We make that real estate data available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at those signals for the week of September 11th, 2023. There are just over 509,000 single-family homes active unsold on the market now. That's up a hair from last week and 7% fewer than last year at this time. Last year, inventory was about to start climbing again with that autumn spike in mortgage rates that we had. Inventory grew in 2022 for the 7 weeks from mid-September, like right now, through the end of October. I don't anticipate that happening again this year. Last year's late summer inventory growth was really a reaction to a big change in mortgage rates. So this year, while rates are high, they aren't climbing now. So over the next few weeks, inventory levels will fluctuate a little bit up, a little bit down in a given week, and then start declining reliably for the fall. In this chart, each line is a year. You can see the last year's light red line that did that unusual jump in mid-September with that 150 basis point spike in mortgage rates. Before that changed, it looked as though inventory had peaked for the year. The lesson is that consumers are most sensitive to changes in rates rather than the absolute level of rates themselves. And this market is very fragile. So even though it's not deteriorating, it could. And for example, if mortgage rates hit 8%, we will definitely see that in the data. Next week, Thursday, September 21st at 10 a.m. Pacific is our monthly Altos Research webinar, the hour-long webinar. We'll look at all the latest inventory data, the forecast for the rest of the year, plus all the details on pricing, all the demand indicators, and all the local market analysis. If you need to understand what's actually happening in the real estate market, and especially if you need to communicate to others about what's happening in this confusing market, then you should join us. Like it or not, there are home buyers and sellers who are reading the Wall Street Journal and they think home prices are down 13%. So we have to communicate with the real data. These webinars are limited to the first 1,000 attendees, and we always have far more than that register. You can still reserve your spot. There's a link in the description below. Click that to save your spot and join us next week, Thursday, September 21st at 10 a.m. Pacific. As inventory reaches its peak for the year, we can see how this year's high mortgage rates have slowed purchase demand. There are 348,000 single-family homes in contract right now, with only 54,000 new contracts pending in the last week. That's down from 64,000 the week prior. It's a holiday week, so it's always slower, but this year's 14% fewer new sales than Labor Day week last year. September 21, when the pandemic frenzy was still underway, there were like 80 to 90,000 new contracts each week for single-family homes. And this year we're at 54,000 right now. So there's no getting around it. Supply is limited. Demand is limited. There's just no sign of sales volume increasing. I keep looking for it, but it isn't here yet. In this chart, each bar is the total number of single-family homes in contract in a given week. The light portion of the bar are the new contracts for the week. At the far right end of the chart here, the bars are getting shorter, and the light portion of the bars are getting shorter. Maybe in October, we'll have year-over-year growth in the new contracts because last year the fourth quarter was frozen so solid. You can see in the middle of the chart how quickly the bars got shorter each week in Q4 last year. Hopefully, this year has a slightly stronger pattern. I say hopefully, I keep hoping. If rates tick down, then we will see an uptick in the offers being made. Price reductions actually dipped this week to 36.1% of the homes on the market from 36.2% last week. That surprised me because price reductions don't usually peak until October. I suspect what we're seeing is probably an increase in withdrawn listings. These are homes that had been on the market, not had offers, had taken a price reduction, still no offers, so now they're done trying to sell for the year. We had 54,000 new contracts this year, but probably another 20,000 or so withdrawn from listing. So in this chart, each line is a year with the most homes taking price cuts late in the year when sellers are trying to get a deal done before the holidays. I expect more price cuts before the month ends, but it is mildly encouraging that price cuts didn't accelerate this week. The takeaway here is that in a market that is deteriorating, price reductions will be climbing, and that's just not happening right now. Last year it happened twice. First, starting in March after rates started climbing and price cuts started climbing very notably. It happened again in September, like I mentioned, after that last spike from under 6 to 7.5% on the 30-year mortgage. That 150 basis point change in mortgage rates surprised everyone. Offers stopped, sellers had to cut their prices. And you can see that extra jump in the September of the light red curve in this chart. It wasn't until November, when the withdrawals started happening, it started accelerating last year, that the price cuts as a proportion of the active listings started to reset for the new year. So again, the takeaway here is that as price reductions are flat, now over 36% of the homes on the market shows us a slow market, but not a deteriorating market. And like every week for the past couple of years, we're on the lookout for signals that the market might be deteriorating, might tank. Can consumers handle mortgages over 7%? Seems unlikely, but price reductions had been accelerating over the past few weeks when mortgage rates inched up to that multi-decade high. Rates have inched lower in the last couple of weeks, and we can now see that the slow housing market isn't deteriorating further. It's not a repeat of last year. Unless mortgage rates spike to 8%, then we will definitely see that price cuts pattern again. I've been pointing out lately that it is more the change in mortgage rates rather than the absolute level that consumers are responding to here. And we can see that in the pattern of home list price reductions across the country. The median home price in the U.S. is now $444,990. That's down 0.7% from last week and still up about 1% from last year at this time, basically unchanged. The median price of the newly listed cohort is $390,000 now. That's down from last week and essentially also unchanged from last year. In this chart, the dark red line is the market price, and the light red line is the price of the new listings each week. the prices tend down in the second half of the year. And these changes that we're seeing now look totally normal seasonal action. I mentioned that Wall Street Journal article that was so misinformed. And the writer was trying to use new home sales prices from April to paint a dire picture of the whole US housing market now. But really, when we look at the actual market, we can see exactly what is happening. And here's what we know about home prices around the US. We're in a supply constrained market. There have been sufficient buyers to support prices all year long. When mortgage rates move from 7 to 7.5% this summer, we can see a damper on buyers. We can see that capped any year-over-year home price gains. And affordability matters, and consumers adjusted very quickly. So home prices for 2023 will be roughly flat from 2022. Since inventory isn't falling, and is down just a little bit from last year, that's an indication for prices for 2024 will also be roughly flat compared to now. Some firms have been forecasting like 5% or more home price gains in 2024. I'd have to say that there's nothing in the current data that shows me that much home price strength in the next year. So that forecast would be dependent on mortgage rates falling substantially before, say, Q2 next year. At Altos, we don't forecast mortgage rates, so your guess is as good as mine whether that happens. But there's nothing in the home price data now that indicates, that shows me significant home price gains for 2024. That's why we expect another year of flat home price changes by next year. And we'll do more of that in the hour-long webinar on a week from Thursday, the 21st. When we look specifically at the price of the homes heading into contract each week, we see the median price is at $379,900. That's also 1% above last year. This chart shows us contract prices last year versus this year. Early in the year, prices were coming in below 2022. Now they're coming in a fraction above. October of last year, home sales prices took that notable dive with the spike in mortgage rates. And so we'll see a seasonal decline over the next few months, but the annual comparison probably gets easier from here. So in summary, we can see that the transaction volume does not show any signs of strength, but because this is a supply-constrained market, the limited number of buyers have kept a floor on prices all year long. That pattern is still intact. As I mentioned, don't forget our webinar next Thursday, September 21 at 10 a.m. Pacific. Click the link in the description below to reserve your spot. These are where we spend an hour on all the latest data in the forecast. There's so much signal in the active market that the lagging closed sales prices like they used in that journal article simply don't have any insight. So if you need to help buyers and sellers understand the housing market, help them make decisions, go to altosresearch.com and book a free consult with our team. We will help you talk about the market with your clients and prospects today. There's a link in the description below to join us at Altos. Okay, more next week.